Hello everyone, my name is Matt Cucullu, and this is my interest rate forecast project for the week of October 14th to October 18th. Beginning on Monday, October 14th, the bond market was closed for Columbus Day, so there were no Treasury quotes available for this day. On Tuesday, October 15th, the government shutdown continues. There is news of a potential deal by Congress to end the shutdown, which would fund the government until January 15th of next year. On Wednesday, October 16th, the Federal Reserve had decided to hold off tapering because of the government shutdown. Tapering is the buying back of bonds, U.S. issued securities, to pump money into the U.S. economy, which would stimulate the economy. They will continue to do this, and they're projected to begin talks about tapering at their meeting in December. On Thursday, October 17th, the government shutdown had finally ended. Congress and the president finally reached an agreement. The shutdown lasted for 16 days and was the third longest shutdown in U.S. history. Government employees are back at work now, and the debt ceiling is raised until February 7th of next year. Well, they will have to decide again whether or not to raise the debt ceiling. And finally, on Friday, October 18th, the Federal Reserve had decided to hold off on tapering until a permanent solution is found on the U.S. fiscal side. They're going to wait to see what the government does about the debt ceiling, and they will continue to buy bonds at a rate of $85 billion a month until February at the earliest, which would pump money into the economy, stimulating the economy, keeping rates down. So rates are projected to stay low until at least February. Here's a graph of Treasury yields for the next 30 years. As you can see, from Tuesday to Friday, rates had shifted down slightly, but there's a bigger gap on the longer end, which means that rates actually flattened. This is mainly due to the government shutdown being over and the Federal Reserve deciding not to begin tapering anytime soon until at least February. So rates have shifted down. Here's a graph of 1-year forecast for the next 10 years. As you can see, again, just like the Treasury yields, it had shifted down from Tuesday to Friday slightly, but it flattened more on the longer end. And this is just because of rates going down, because the Fed has not decided to begin tapering anytime soon until the government had gotten everything settled and figured out. People were afraid that the government would not pay their bills on time. There was some liquidity and risk involved during the shutdown, but once everything was settled, consumer confidence was restored, and rates have dipped just a little bit over the course of the week. So this is my 1-year forecast for the week of October 14th to October 18th. Thank you for listening.